We are live.
Good afternoon, friends. I am Deepak Jasani, the head of retail research, and
Good afternoon, friends. Myself, Gaurav Dhanuka, head online business HDFC Securities. Today we are going to talk about how to make equities as a wealth building tool. Deepak, why do you think most people in the market do not have a good experience on a consistent basis?
see, Gaurav, what is the typical experience of a retail investor in these markets in any cycle? Initially, what happens is the lay person, or the lay traders or investors, they make some money in trading, in IPOs, and then increase their exposure in terms of funds. They spend a lot of time talking with colleagues, with friends about stocks, about tips. They watch TV, they read up newspapers to find ideas, etc. But when the cycle turns, they are saddled with some unsold stocks whose list is long enough, and their profits on the on the sold stocks are offset by the losses on their unsold stocks. They keep hoping against hope that the value of their holdings of the unsold stocks rise, and so that they can exit at a cost to cost, and they promise to themselves that they will never look back at the markets again in their life. They blame everyone, right from their brokers to the experts, to the regulator, to the government, to the promoters, for their predicament. They don't look at their own self, their own actions, their own investment styles for this. And this cycle keeps repeating every now and then. Now, if this has been your experience in part or in full, then maybe this talk will be of some use to you.
So Deepak, how do you think investors or traders should correct their portfolios?
Now, this is more to do with the behavior of investors, Gaurav. Equities have traditionally been known to create wealth and give returns much above the alternative avenues. If you consider the compounding effect, then the difference becomes even more glaring. Investing through mutual funds enables you to sort of partake part of this opportunity. Persons taking direct exposure to equities have seen the Pareto principle, that is 80-20 principle. 80% of the people have average or unsatisfactory experience in equity markets, with only the balance 20% relishing it. Now, who would not like to be part of the balance 20%? Today we would like to share with all of you some thoughts on how to achieve that. For achieving that, we will have to focus on what we should not be doing rather than what we should be doing. We shall talk about 4 things that we as equity participants should be avoiding. First, not having a proper and well thought out allocation towards direct equity. Now, most of us don't have a logical, well thought out allocation to direct equities. Typically, these allocations are ad hoc, based on the momentum in the markets, ideas floating around, and the activity level in our social circles. Out of your financial assets, you ought to have a clear allocation towards direct equity that can be tweaked a little depending on the opportunities. This will bring discipline and hold you back from mindless activity, which ultimately may not be of much use to you. This will also help you avoid over trading in F&O and burn up your wealth. So this is the first thing to avoid. Do not come into the markets without a well thought out allocation towards direct equities. The second thing to avoid would be, do not mix trading and investment. Typically what happens is a participant in equity markets will come into the market, buy something without applying mind whether he wants to buy it as a trading or an investment. So at the outset, try and segregate stocks in which you want to trade and stocks in which you want to invest, along with some idea about the expected returns and your time horizon. If you don't do this, typically what will happen is you will prematurely sell your performing stocks and to offset the losses made out of the trading in other stocks. We all know the kind of returns compounded returns some of the stocks have given over the years, and how much little we have been able to participate or extract out of that return. So to avoid that, please have a clear segregation of which stocks or which set of stocks you want to trade in and which set of stocks you want to invest, along with your expected returns and your time horizon. Apart from, if you don't do this, apart from the loss of opportunities, we are also saddled with unnecessary tax liability. We would be selling some performing stocks before 1 year and paying short-term capital gains tax on it. If you spread your bets too thin, then you won't be able to make any meaningful wealth. So rather than doing mindless activity in countless number of scripts, try and focus on limited number of trading and limited number of investment stocks. Take large bets, maybe you can build them gradually on some investment stocks and track them closely. Don't be in a hurry to book your profits in such performing stocks. So this is the second thing to avoid, in the sense, don't have a mixed view of your stocks, have a separate view of trading stocks and investment stocks. The third thing to avoid is, do not blindly follow the so-called experts appearing in the media. Now these experts may have a different risk profile and may have access to certain information which an individual investor may not have. The expert may change his view on certain stocks and exit some stocks, and the individual will still be left saddled with those stocks, and those may be the underperforming stocks. It is always better to help yourself. Do some self-help, read books, read blogs, read websites, in the same time that you devote to watching all the channels and all the experts, and devote proper amount of time to the equity markets, whether on weekends or whether on weekdays. Choose your own time, devote enough time in doing self-help, doing reading, doing understanding, learning charts, doing technicals a little bit. You will not be able to be an expert in that, but you will have some idea about a lot of ways to identify stocks and to write stocks. And it is not that all the experts that are appearing in the media may not be of much use. You can follow 2 or 3 experts whose investment style matches with your style. You can also follow your broker, track his calls, his reports, his returns, his successes, his style of ideas, and if you find it useful, follow the broker's recommendations. So this is the third thing to avoid. The fourth thing to avoid is, don't become biased or rigid about your stocks. Don't fall in love with your stocks. In case an emerging situation requires a relook at the stocks, please do that. This will help you in being able to look at some new stocks. Because if you are going to have a tight list of stocks, then in case some negative development has occurred in a particular stock, then please look at it closely, and in case you feel the stock has limited upside from now on for the next few quarters, then it will be better to exit the stock and replace it with some other stock where you think the performance is going to be much better going ahead. So if you avoid these 3-4 things, you will automatically graduate towards becoming a better equities person. In the future webinars that we propose to hold, we will also talk about what things you should be doing to increase the possibilities of making more money out of equities.
Well, Deepak, so I agree to all your points, and these has been the discussion points actually with my friends who keep on asking certain questions, where sometimes I am able to answer few questions, but I hope all my friends are attending this webinar and would be very grateful to Deepak who can answer all their queries today. While Deepak, though we are on the equity side, but as you rightly know that there are currently 2 IPOs going on, so we would like to have your views on that as well.
Yeah, 2 IPOs are open currently, Gaurav. One is PNB Housing IPO, which has come at a time when BFSI stocks are in fancy and they have seen an improvement in their valuation parameters. The financials of the stock are impressive and there is enough potential in the space. Varun Beverages, on the other hand, is a bottler and has seen a turnaround in performance over the last few quarters. So whether this turnaround in the performance sustains has to be seen to get a handle on its valuation.
So Deepak very rightly said, and just to share one more thought along with the Deepak, timing in the market is also very important, and you have to be on the spot, for which if every customer is downloading our mobile trading application, it will help them to keep them updated all the times, and you can act as well. The customers who have downloaded, they would have find that they get the notifications from our research calls, and they can immediately act on those research calls. So that is the power of mobile, which we all should leverage in the capital markets. So now we would be taking some questions. I will just check out what are questions we will say.
Yeah, there are some 228 questions, Gaurav. A lot of people are interested.
Right,
I think
right.
from across the country.
Yes, I can see all the cities which I can think of. So we'll just take quickly one question.
Few
from
questions
here.
which are relevant to the topic that we are currently
So the first
discussing.
question is coming from Mirza Shamim Imtiaz, and
From which city is?
so he is from Lucknow, and his question is very right at the very right time to build a good portfolio from this Diwali to next Diwali. So what are your
Right. Diwali is a good event or a good festival time to sort of relook at equities and to build a portfolio for the coming year. So here we have our Diwali picks. We have released the Diwali picks on this Monday. We have about 8 fundamental picks. We also have released some technical picks. You can go to our website, visit our website in the reports, research report section, go through the reports, and if you agree with those recommendations, you probably can act on that. Now, Virendra from Amreli says that, is it safe to trade or invest in all stocks suggested by Pick of the Week by HDFC? Now, Pick of the Week as a product we have introduced over the last 2 odd quarters. The track record so far has been quite good. We have been flashing the track record on the website from time to time. I think if you can allocate some portion of your equity money into investing in Pick of the Weeks, and gradually and typically we are getting exit from the Pick of the Week on an average basis in about 2 months time. So if you invest in say 8 stocks on a rotational basis, you will be able to sort of churn it. Of course, 1 or 2 stocks in between may get stuck or held up due to various reasons, but on an average basis, if you invest for 8 weeks, you can sort of churn your portfolio every 8 weeks and earn the returns which are generated by the Pick of the Week. And typically, you should do in all the Pick of the Weeks rather than pick and choose on your own. That is an advice that we would like to give. Can you, Shahu Mali of Pune is asking, can you guide on time frame to be used for trading? I am a swing trader. Now, basically the time frame will depend on what kind of charts you are looking at, what time period of charts you are looking at. If you are looking at intraday charts, your time period is intraday. If you are looking at daily charts, it is 1 day or maybe 2 days. If you are looking at weekly charts, probably 2 or 3 weeks. And if you are looking at monthly, and so on and so forth. So it will all depend on what kind of charts or data you are looking at. Based on that, you can sort of decide on the time period of holding. Srinivas from Visakhapatnam has a question. How about banking sector? Should we take long-term view on large cap banks, particularly in view of provisioning, dragging profits? Yeah, a very relevant question. Yesterday we had Axis Bank coming out with numbers, provisioning, pulling down the profits. So PSU banks as well as some private sector banks who have a lot of corporate sector exposure have been saying over the last few quarters that the worst of the provisioning is over, but we have seen over the last 2 quarters that every time the worst is not yet over, we are still sort of required to make new provisionings, new assets to be watched, watch list is expanding. So in that sense, probably till there is a big turnaround in the economy, this situation could continue. Now BFSI has a very big weightage in the indices, so in that sense people will keep investing in banks, they will keep reshuffling between one bank and the other bank. There will be trading opportunities. We have seen ICICI Bank rising by 40 or 50 rupees in a matter of 2 weeks. So these things will keep happening. So till there is more clarity on the provisioning and the economic turnaround, I think the larger banks having corporate exposures should be looked at as a trading opportunity rather than an investment opportunity.
So the next question is coming from Mr. Lokesh Arora from Faridabad, who is saying what should be the percentage distribution among large cap, mid cap and small caps in his portfolio?
Yeah, here typically now one will have to see what is the age of the investor, what is the risk profile and what is the time horizon. Now typically if you are a young investor, if you can take risks and if you are not in a hurry to sell, then probably a larger exposure to mid and small caps is warranted. And if you are say above 40 and cannot take too much risk, then probably a larger allocation to large caps is recommended. But on an average broad basis, I think 30, 40, 30 in the current circumstances looks like a reasonable allocation. Of course, if you cannot take too much risk, then probably this 40 and 30 will have to reduce, and that will have to go to the large cap.
Okay. So next question is coming from Mr. Abhishek Soni from Hyderabad. His question is elaborate on SIP on stocks, which is a good daily, weekly, monthly. Also, SIP in mutual fund is better, or it is SIP in stocks is better?
An interesting question. Now we, as you know, HDFC Securities is offering the facility of DIY SIP through mobile, through online, through call center, through branches, etc. So we have been one of the pioneers in introducing that. So we saw an opportunity in DIY in direct equities, DIY SIP in direct equities. DIY, the SIP in a mutual fund has been there historically for quite some time. Now SIP in mutual fund is for people who are not so educated about stocks or who don't have much time to sort of devote to equity shortlisting and tracking. So your first preference should be a SIP in mutual fund, and once you have given enough allocation to that and you are savvy investor or an executed investor, then probably you can do a DIY SIP in equities also. There you will be able to sort of build a portfolio of individual stocks over time, where you will get the value averaging benefit also.
So I have a question coming from Germany as well, from Mr. Shirish, who is saying I have two questions. One which says that is it always good to invest in all the IPOs? And the second question is how much percentage of investment should be allocated in SIPs?
Yeah, IPOs over the last few quarters have given very good returns on a broad basis. There have been some IPOs in between which have gone below the issue price also. So a broad brush statement cannot be given that all IPOs should be invested in. So for that matter, you will have to read reviews, you will have to do some study yourself, you will have to talk to people who matter, who are experts and on whom you can trust for deciding whether you should be applying to a particular IPO. Here the track record of merchant banker is also relevant. The sector from which the IPO is coming is also relevant, whether that sector is in fancy currently or not. So those things have to be considered. So all IPOs you need not apply, but in a good time you can apply in most of the IPOs, barring say 20-30% of the IPOs where the valuation is overboard. Okay. The second question that he has is
on that.
What is the question?
How much is the investment to allocate in SIPs?
How much percentage of investments to allocate in SIPs? Now, SIPs, out of your financial assets, it all depends as to how much. First allocation will be broadly between the debt and equity, and within those, now debt is a separate portion. Within equities, you will have allocation between indirect exposure through mutual funds and direct exposure through direct equities. So, and out of that, you can also have SIP as well as lump sum investments. So now this is again not a very general answer cannot be given for everyone. It will all depend on how much time you can allocate in studying stocks and in tracking stocks. If you are a person who is busy with your normal activities, then probably you have very little time to devote to equities. In such a case, most of your equity related investment should be through SIP, either MF SIP or DIY SIP.
So the next question is coming from Mr. Jitendra Thakur from Mumbai. Very relevant questions. Give me one multi-bagger pick as a Diwali gift.
Yeah. So everyone is looking for that multi-bagger. Now we have given those 8 Diwali picks. In some of the cases, the returns expected are more than 60-70%. So if you think those are multi-baggers, then good enough. But here I would like to again clarify that most people are not able to make a good amount of wealth in pursuit of multi-baggers. So if you, for example, would have invested in our fundamental stocks or in pick of the weeks and compounded them, exited them at the target prices, then probably our pick of the weeks or the fundamental stock picks have given an average of 23% return on an average time holding of about 60 days. So if you multiply 23 by 6, because 6 times you can churn that, then that would be 120%. But let us not be too having very high expectations. Even if you churn it twice or thrice a year, you would still make 40-60% return, which is much better than your fixed income returns and which is closer to your multi-bagger kind of returns.
So it's what a coincidence. While answering this question, I just got a notification which says Diwali pick by India Cements. And while Deepak was answering, I was just clicking on it. I clicked on it. I went to the app. I logged in. I placed an off-market order. So I'm not worried about tomorrow morning to open. It's a Diwali pick with a good tenure. So I'm already invested.
Yeah.
So we'll take our next question.
Now there are certain questions about individual stocks. We will refrain from answering them because unless they are under our coverage, we will not be able to answer them. Now Abhishek Malia from Mumbai has asked that should we hold share for 1 year in this volatile market, and or should we sell once the share reaches 25% gains? Now again, I covered this partly in the previous talk. If you have a segregation of trading stocks and investment stocks, then on the investment stocks, if they have started performing, say in the first quarter or the second quarter of your investment, then probably there is no hurry to exit even at a 25% gain. You can hold on for about 12 months or more and get the tax benefit. For trading stocks, you can exit even if you don't reach 25% in a short period of time. So it will all depend on what is the initial segregation that you make at the time of investment. Now, a lot of the time, equity participants are in a hurry to take profits. A bird in hand is better than two in the bush is what they believe in. But every time it may not be prudent to do that. We will have to allow the two birds in the bush to grow very big in size occasionally, I think.
Very rightly said.
Yeah.
So the next question is coming from Kunal from Bangalore. Many of us ask the similar questions when we are just entering. That need your guidance for new entrants in the trading.
Yeah, this also was partly covered in our previous discussion. For people who are new to the equity markets, IPOs is a good route to start, number one. Number two, and that can be easily done through our portal. It's so easy. I think a couple of clicks and you are done. You don't have to fill those forms and all. So IPOs is a good starting point. Second is you will have to devote time. You will have to do some study yourself. You cannot just invest or trade based on hearsay or tips. Even if if that person is an expert. As I said, experts can have different perspective, different risk profiles, etc. So do some self-help, devote some time. If possible, learn a little bit of charting and watch television, shortlist 2 or 3 good experts whose styles match with your styles, read blogs, read websites, and start with small trades. And keep money management rules under control, follow them, have strict stop losses in place, have trailing stop losses if your trade is in your favor. So these are some things that you can do, and keep a diary of your trades and write down your experiences. Even if it is a loss, why did you incur a loss? Keep reading that diary again and again so that you don't repeat that mistakes.
Okay. So next question is coming from Anand from Sambalpur. He's asking, can you please clarify about the use of stop loss and target price? Is it only meant for intraday trading, or we can fix this for a share for a longer period as well?
Yeah, typically stop losses are for trading only, but you can use them for investment also. In a sense, you can have trailing stop losses. Now, as we discussed earlier also, a lot of the time equity participants make the mistake of exiting too early or too prematurely, under the fear that if they don't sell now, they will have to sell at a lower price. So in such a circumstance, what they can do is they can, once the share price has risen a particular percentage above the cost, then they can have a mental trailing stop loss in place. And then if the stock price goes below that, then they can exit. But and keep raising that trailing stop loss as and when the stock price moves up. So in that sense, then you don't have the worry. You will have some profits in your pocket even if the stock price starts falling, and you will also participate in a larger pie if the stock price keeps rising.
Okay. So in the interest of time, we are just going to take the last questions for the day, which is from Mr. Didas from Rourkela. His question is, how do I differentiate between a trading and an investment stock?
Now, this is a tricky question, but let me try and answer this. Investment stocks are those stocks where there is a macro development related opportunity, or where the company has undergone a change whereby it is able to capture bigger opportunities, or where there is a big restructuring or a big change of level in a particular company. So these are broadly the stocks where one can invest for a slightly longer term. Trading stocks, on the other hand, are basically momentum plays. They may be flavors of the day or flavors of the week, or when a certain stock is oversold or it has fallen quite a lot due to various reasons, due to delivery sales by institutions or non-institutions without any major negative reason, and we are expecting a bounce. So that can be one reason to trade in a stock. Or when stocks have given breakouts, all-time highs, 52-week highs, etc. At first you can trade in those stocks and then probably look at them slightly deeper to find out whether they are worthy of even investing. Because typically there is a reverse mentality in the markets that stocks at 52-week high or all-time high should be sold. Now that may not be necessarily the case every time. Stocks which have given compounded returns would have always made 52-week high and all-time highs. So whenever stocks make such highs, look slightly deeper into the fundamentals of the stock and try to find out the reason for that. And in case you are convinced with the reason after looking at it at reasonable depth, then probably it becomes an investment stock.
Right. So with this, Deepak.
Yeah, thank you all for attending the webinar, and we hope you would have found this of some value.
Right, and with this we will be coming up multiple webinars in the coming months, and on behalf of HDFC family, we wish you a very happy Diwali. Stay
And a prosperous year.
Yeah, thank you.